The World Bank says economic growth in Kenya would accelerate to 6.1% by the year 2020, but Kenya needs to recalibrate its budget deficit and boost the development expenditure. The National Treasury has embarked on various austerity measures to cut expenditure by 1.4% this year. The most affected will be the development vote. World Bank Chief Economist Alan Davis has cautioned against Treasury's move to cut the development funding, saying this risks reducing the capital stock of the economy, which may have implications for long-term growth.
Over the past 5-6 years, a large expansion from the government spending side has contributed to growth. And if we look at the budget policy statement, and if that follows through, there's going to be a little bit of a drag, or at least the extent to which fiscal spending contributed or government spending contributed to growth is going to be weaker than it was before. I think that is not necessarily a bad thing, because in the overall range of things, this contributes to macroeconomic stability, so that's good.
The World Bank says Kenya should trim the wage bill by harmonizing the salaries and wages of the civil servants, especially those in top job groups. Kenya's debt is seen hitting an all-time high of 55% of the GDP by end of June this year, from 40.6% in the 2011-2012 fiscal years. The bank is cautioning the National Treasury against the borrowing binge in the face of shrinking revenue margins.
When we see development spending, so most of the slowdown in the pace of spending is coming from development spending. I would say that in terms of the quality of fiscal consolidation, and also to protect the long-term growth potential of the Kenyan economy, it will be important to recalibrate the slowdown from the development vis-a-vis that of recurrent spending.
We do look to a more quieter political year in a few coming years before we're back to elections, but also really start thinking about how do we separate elections from the economy and ensure that the economy doesn't take a beating during the election years.
The annual economic report by the World Bank says private sector investments' impact on growth had fallen to negative 0.7% points of the GDP in the 4 years to 2017, from 1.3 percentage points in the 4 years to 2013.